Hello there. Today, we are going to discuss a topic that is often on the minds of investors, the possibility of losing all your money in SEBI. Before proceeding, please like this video and subscribe our channel for more such videos. If you are fearing of losing your money with SEBI investment, then fear not, because we're here to tell you that although the risk of losing your investment does exist, it becomes almost negligible over a long enough time horizon. Let's take a closer look at some historical data to understand this better. We'll examine the three worst bear markets of the last 20 years and see how an SEBI investment would have fared during these times. The first bear market we'll discuss is the Ketan Parikh scam and the dot-com crash of 2000-2001. This correction lasted the longest and caused the Nifty to fall more than 40% from its previous all-time high. It took more than 4 years for the market to recover. However, if you had started SEBI during this time and stayed invested for at least 5 years, you would have eventually made FD-beating returns. The second bear market was the financial crisis of 2008, which caused the Indian market to crash more than 50% in just 15 months. Again, if you had started SEBI during this time and remained invested for at least 5 years, you would have eventually made a decent return. The third bear market occurred between 2011 and 2013 when the credit rating agency downgraded the US sovereign debt rating. This caused a panic in the market, and stocks around the world fell drastically. But once again, if you had started SEBI during this time and stayed invested for at least 5 years, you would have eventually made a decent return. Now, let's consider the worst case scenario for any investor. You started a monthly SEBI of 5,000 at a market top, and as soon as you started your SEBI, the markets crashed. If you continued your SEBI through the correction and stayed invested for at least 5 years, you would have lost zero money. That's right, zero money. To further drive this point home, let's look at some numbers. We'll examine the returns of a monthly SEBI of 5,000 in Nifty 50 during the worst bear market phases we just discussed. During the Ketan Parikh.com bubble phase, which was between March 2000 to March 2005, it took more than 3 years for the SEBI to give positive returns. However, with a cumulative investment of 300,000 through monthly SEBI during this phase, you could have accumulated a corpus of around Rs. 523,200. During the financial crisis of January 2008 to January 2013, the severe price correction took 6 years to go back to the same level as it was in January 2008. However, your investments turned positive in less than 18 months. With a cumulative investment of 300,000 through monthly SEBI during this phase, you could have accumulated a corpus of 395,000 at a compounded growth rate of 10.11%. Finally, during the phase of 2011 to 2016, we saw 3 deep corrections, but it took only 12 months for SEBI investments to turn positive. With the cumulative investments of 300,000 through monthly SEBI during the investment phase, July 2011 to July 2016, you could have accumulated a corpus of 401,248 rupees at a compounded annual growth rate of 11.59%. Now that we have seen the historical data and the potential returns of SIPs over the long term, let's discuss why this is the case. Firstly, SIPs are designed for long-term wealth creation. They are meant to help you accumulate wealth over time by investing small amounts of money regularly. This regular investment approach helps you average out your purchase cost, which means that you buy more units when the market is down and fewer units when the market is up. Secondly, equity investments are subject to market volatility. The market can be highly unpredictable and volatile in the short term, but over the long term, the stock market has consistently shown a positive trend. This is why it is essential to remain invested for a long enough period to ride out the market volatility and benefit from the long-term positive trend. Finally, SEBI provide the advantage of compounding. Compounding is the process of reinvesting your returns back into your investment to earn additional returns on the principal amount as well as the accumulated returns. Over the long term, compounding can significantly boost your returns and help you achieve your financial goals faster. In conclusion, if you are considering investing in SEBI, it is crucial to have a long-term investment horizon and not get disheartened by short-term volatility. SIPs are an excellent way to invest in the stock market and create long-term wealth. By staying invested for at least 5 years and utilizing the power of compounding, you can potentially earn high returns that beat traditional investment options like fixed deposits.